Hi, it's Eric Nuttall of the Ninepoint Energy Strategies. We wanted to spend a few minutes to review 2024 with the year coming to an end, but more importantly, focus on key themes for 2025. 2024 year started off quite good. Energy stocks performed very well in the first half of the year. I think we were up roughly 25% at one point this year. Fast forward to the second part, sentiment got extremely challenged for a couple of reasons, which we'll review. And by the end of this year, it looks like oil will end roughly flat. Canadian energy stocks are up about 9 to 10%, with US energy stocks down. And so what were some of the challenges in 2024? It's curious that much of our thesis around the oil market came to pass. We had global inventories fall when many people at the beginning of 2024 thought that they would build. They've fallen pretty significantly and now are at their lowest levels on a seasonal basis in recorded history, meaning as far back as satellite imagery growth goes to 2017. Demand, we know, grew a little less than expectations, namely due to Chinese weakness for a couple of months this year, where demand was actually down year over year, which is not something many people thought. But contributing to the tightness, we had the strong cohesion within OPEC, the extension of certain deals, improved compliance on the part of some members. US shale very firmly disappointed, but yet we had all of these false narratives, and we had to, I think it was really a series of them that contributed to what is now a sentiment challenge and is making the market far more bearish than it should be as we enter in 2025. And so when we think about what were those false narratives throughout the year, we've had to deal with worries about the US economy. It feels like everybody's been terrified of a recession for the past 3 years. All of the economic data would firmly put that to bed. We now had to deal with the narrative around, surging US shale production. And that was feeding the false narrative that, well, OPEC is losing market share, Saudi's losing market share. They're going to, end the deal early and they're going to crush the market by flooding barrels. We know that simply was completely wrong. When you look at US shale, it looks like it's going to exit 2024 roughly flat with where it started in 2023. When we look at OPEC cohesion, very clearly, a lot of the rumor mongering or fear mongering was completely wrong. The key concession that UAE gave to defer and being able to add to their baseline, the agreement of extending the deal through April of next year, extending it over 18 months, over 12, et cetera, firmly shows that cohesion within OPEC Plus, it remains very, very strong. There was the fear that non-OPEC growth this year was going to be very strong. We mentioned that US supply was weak, but other countries like Brazil, massively disappointed. And yet that's feeding some of the narrative about 2025, about why the market is going to be imbalanced. So as we approach 2025, where do we stand? I mentioned inventories are at their lowest levels in recorded history. Demand is at its highest levels in history. We have the expectation of a year of robust non-OPEC supply, mainly coming from the United States, from Brazil, a bit from Canada, a little bit from Norway. We think expectations are too high. They roughly sit at about 1.4 to 1.6 million barrels per day, depending on who you ask. We think the likelihood of Brazil disappointing again, not unreasonable. We think expectations of US shale are completely incorrect, given that companies are now in their budgeting time. We've already had forward guidance from companies like Diamondback saying we wouldn't even contemplate growth at this point. We have Chevron speaking about how they're going to be guiding to a plateau. Even Exxon, there was some confusion pro forma with Pioneer. The combined guidance actually missed expectations by about 100,000 barrels per day. And so we continue to think that US shale has entered into its twilight. The era of meaningful growth is over. And in fact, we'll get to a theme later on, but under the Trump presidency, we think he will bear witness to the peak of US production and the end to this US energy independence fantasy. So the concern that we're going to be building inventories really relates to ongoing weakness in the rate of growth in demand, which is fair. I don't think any of us have an edge in calling whether Chinese stimulus will be effective or not. Even assuming complete ineffectiveness, demand growth expectations next year sit at about 1.2 million barrels per day. And so even if non-OPEC supply growth exceeds expectations or meets expectations, any builds that we're going to have are pretty modest. In addition, it's starting from the lowest base in history. And so it's odd to me that we had inventories massively decline this year, that it was price agnostic. The price didn't do anything. And yet we're going to modestly build next year. And it's making some people think that, we should be heading to 40 or $50 per barrel. We cannot fathom the logic embedded in that argument. As we approach 2025 and 2026, not that far away at this point, what we see next year is the last year of meaningful non-OPEC supply growth. That is coming to an end due to the lack of investment from long cycle projects, finally, the combination of declines in many countries in the world, and finally, the twilight of US shale. We think next year is the last year of any modicum of growth from US shale, a couple 100,000 barrels at best, and that ends. Why is that so important? Over the past 10 years, non-OPEC supply has grown by 5 million barrels per day. Over that same time frame, US shale, which is a component of non-OPEC supply growth, has grown by 6. So more than 100% of all of non-OPEC supply growth has been US shale. Even with Guyana and Brazil and certain other pockets, Canada, many countries are in perennial decline. And so as we get past 2025, and I don't know how far into 2025 we need to get, the market's focus should start to turn to 2026 and beyond, where non-OPEC supply growth is going to rapidly decelerate, and in fact, beginning around 2027, have almost no growth. And that's just not a one-year trend, that's a forever trend. Why is that so important? It is going to allow OPEC to begin to return barrels to the market, perhaps in April of next year, perhaps a little longer, and to be able to normalize spare capacity, which seems to be the reason why we put up charts on X of global inventories, and people say, well, it doesn't matter anymore, right? Spare capacity is so big. And I've seen numbers as high as like 8 million barrels per day of spare capacity. I don't know what those people are smoking. Like the real number is closer to 4. And the element that people are not figuring out is not only is the number important, 4 in a market of 104, 105 million barrels per day is pretty small, but who holds that spare capacity? The majority is held by Saudi Arabia. And so what is their intent? What is their willingness to bring that spare capacity on at a time when demand fundamentals for next year, unknown, when very clearly we think the necessity of a higher budget-friendly price, a price perhaps more deemed to be fair both for the producer and the consumer, and especially at a time when I think their awareness of the growing influence of they and OPEC going forward in the years ahead is only getting stronger and stronger and stronger. And so a barrel not returned today is a barrel returned later on at what I believe they would think to be a significantly higher price. And so we think the market is far too bearish right now. We think that with the combination of record low global oil inventories, record high demand, disappointing US shale and non-OPEC supply, ongoing cohesion within OPEC, 2025 is kind of a digestion period. It's reasonable to think that oil is going to be trading at a 70, we think, to an $80 band, with a significantly higher price to that beginning in 2026 and going forward. Ultimately, having to get a point where even I've heard conversations around peak OPEC supply later this decade. Ultimately, the oil price will have to reach to a point where it rationalizes, it kills demand, and then we're back into triple-digit territory. But we'll have that conversation in a few years from now. Just at a $70 to $80 band, we are actively buying positions where we think they can buy back 11, 12% of their shares outstanding next year. And it's a reason why that return of capital element is so strong. Also, we have a material focus on natural gas heading into 2025. We'll have 3 different LNG facilities coming online, 2 in the United States, 1 in Canada. We've had modest heating demand so far this winter, so the imbalances are not contracting as much as what we all would have hoped for. But really, the conversation around 2025 is the build out of LNG capacity combined with the long-term view of increased power demand related to things like AI and such. And so as bad as sentiment feels today, we've had energy stocks sell off roughly 12, 13% month to date. When you look at relative performance to other sectors, we think that the combination of tax loss selling, which is going to end in a week or so, the source of funding to go invest in securities like a fart coin, which now has a market cap in excess of $1.1 billion. We think the outlook for energy stocks is materially better heading in 2025 than consensus believes. We hope for the potential for a pretty strong Santa Claus rally once the tax loss selling ends, because we're seeing that pretty aggressively on a day-to-day basis now. And so we remain bullish. And the definition of that has changed over the years. Right now, that just means we don't think oil is going to collapse to $40 or $50 per barrel. We think at a $3.50 gas price next year, a $70 to $80 price band for the price of oil, the combination of delevered balance sheets, significant free cash flow, and using that to continue to buy back shares lends itself to a materially better year in next year and than the prior two. Plus, we do think that the focus will eventually turn to oil balances beginning in 2026, where there is the beginning of a persistent and chronic deficit between supply and demand. We think OPEC spare capacity can normalize a lot faster than people believe, given that it's much lower than what people commonly believe. And so the prospect of meaningfully higher oil prices, we think, is much sooner than the market believes right now. So with that said, we wish our clients a very happy holidays, Merry Christmas. Wish everybody some time to decompress and come back into 2025 rejuvenated. We feel very optimistic on the outlook for energy share price performance, especially given the bludgeoning that we've experienced in December of this year. So with that, we look forward to chatting again in the new year.